Welcome back to Exchange Trade Capital. I am your host, Rick Allenbach. Tonight we are talking about life insurance, an investment, question mark. Let me save you the drama. No, it's not an investment. It is a death benefit. Anyone who tells you it's an investment is someone trying to sell you an expensive policy. And we'll go through that in a moment. I will tell you though, life insurance is pivotal. If you do not have any, tomorrow, go get some. Get a quote, get an illustration, get your meds scheduled, and bind that policy by cutting a check so that you're insured. Life insurance is absolutely important. But lately, with the markets as they are, I'm hearing a lot of people talking about moving out of the market into permanent insurance, especially whole life. The biggest culprit of them all, and we're going to talk about that. I'm also going to show you a comparison between whole life and buying term, invest the difference, and kind of everything in between. So with that, let's talk about the different insurance policies, how they work, how they're structured, and what they're used for. Every insurance policy, it's important to understand, has a purpose. That doesn't mean they're sold for that purpose. And we'll get into that. First is whole life. Whole life is permanent insurance. A lot of times it's up to 99 years of age. Sometimes it's up to 120, but typically 99. Permanent insurance. It's extremely expensive, and we're going to get into that. A lot of very, very accredited advisors or people that advise advisors call this the worst investment in the world for your money. I'm not going to say that, but I could. It's referred to, a lot of the people that sell it, as the rich man's Roth, which offends the hell out of me for folks who maybe can't afford it, and it's not a Roth IRA. Not even close. So they use that, and they should kill that, along with half of the marketing that is total bullshit. It can and often does pay a dividend. Money grows tax-free, so that's a positive. 40% of policies lapse in the first 10 years. 40% of policies lapse in the first 10 years, meaning people can't afford them. They come in for insurance. And they're always told to pay up. They have these great illustrators and interactive activities and videos to show. And someone who needed probably term, maybe a little bit of permanent, certainly not whole, gets sold this massive whole life policy. The broker gets a massive commission up front. No money, no real cash goes into the policy for the first 7 years. So really they figured out that as long as you have it for around 10 years, it doesn't make a difference whether you keep it or not. When you die, and this is never told by the way, when you die, the cash value goes back to the life insurance policy. So everything you get the death, your beneficiaries get the death benefit, but the cash value you don't get. So that's a little something that they don't tell you when they push you into those ridiculous non-guaranteed illustrations that look so fantastic for you when you retire. Because that's what they push you towards, by the way. They don't talk about the massive annual premium. They talk about what's going to happen when you retire. And they talk about how unstructured the markets are. And they always start with simple things like, do you have an umbrella policy? Is it maxed out at $2 million? Oh, it's not? Why don't you call your agent and get that done? That's like $8, $80 a year. See what I did for you for free? So I didn't get that $2 commission? Well, I'm about to sell you $1 million whole life policy and get a $10,000 commission in 5 minutes. So it's always things like that. They want to shit all over 401ks and investments. Through my earlier videos, we talked about how to play that 401k. We're going to talk about how to play insurance tonight. The death benefit will grow, or it becomes a mech. So it has to grow when the cash value grows. That's fine. There are reasons for whole life policies. Whole life policies, if you got a $50 million estate and you don't want your beneficiaries to pay the hell out of taxes, permanent insurance is for you. I'd use universal, or even a variable universal combo. It's going to be less expensive. You can actually get some real returns out of it. So I would argue against whole life every day, all day. You know, there is one exception. I mean, I have 3 children, 11, 8, and 4. They all have whole life policies that I got. That's more so that I can, you know, I've maxed out 529s for them. They are covered in terms of everything that I could think to cover for them in terms of investing. So I have a whole life policy so they can start with some cash value and an insurance policy. They can do whatever they want with it. That's the only reason. I would never do that as a primary source. In fact, other ridiculously successful and intelligent advisors that talk on CNBC and Bloomberg say the only reason whole life should ever be used ever is if you've maxed out everything else in terms of investing. Well, how many people have done that? So that's whole life. You can tell how I feel about it. Because I know a lot of people that sell it, and I've seen the sell, and I don't like it. Term life. Well, this is permanent, so this goes on forever. That's a good thing. Death benefit is finite. So you have 20-year term, 15-year term, 30-year term, 40-year term. You have all kinds of different terms, but when that term is over, term ends, there's nothing gained. Doesn't build cash value. Very low cost. So we're going to do a comparison at the end of this when I go through these things of whole life, which is getting sold a lot right now. And it absolutely is the worst time to buy whole life, like ever. And I'll show you an illustration that was showed to me by someone who is buying it, and I'm not going to talk him out of it. I'm not a fiduciary or his advisor or anything. He showed it to me, and I gave my opinion. But you know, I think he was convinced to take the policy, and that's fine. But I was given permission to at least use the illustration portion of it to show you the difference of what could happen. So term life. So you have a lot of things here being said. You know, this is permanent life. It does not have any correlation with the stock market. Where here we say, okay, buy term, invest the difference. So invest the massive difference between premiums. Hence, massive difference between commission structures of people that sell whole life. Anybody who sells whole, by the way, can sell term and can sell universal. But I want to see how many times they'll sell you universal, which is also permanent life, and still they're going to want to sell you the whole life. So that's term life. Variable, the cash value can be invested into mutual fund-like vehicles and other investments. It grows tax deferred as opposed to cash tax-free. Cash value and death benefit can fluctuate. They can't. There's a bottom to it, but that's a drawback. I mean, the death benefit won't fluctuate on the whole life. It'll only go up, actually. So that's a downer. So variable is permanent insurance. Often, though, once you start, if the market goes well, people start using returns on the market to pay for the insurance. That can be a tough thing. And if the stock market goes to hell, this can be a dangerous one. But again, you're capped. I will also say on whole life, if you take if you lapse a policy and take whatever cash value you have, it then becomes taxable, a taxable income. So it only grows tax free if you keep the policy in place. Universal is permanent insurance featuring a savings vehicle and component with low premiums. It's also flexible. It's got the death benefit and premium can be flexible. So this, in terms of vanilla permanent insurance, this is the one I like. The one I almost bought for myself to give permanent insurance only as a tool for my loved ones upon my death to pay the insurance. To pay the insurance. I got insurance on the brain. To pay the estate taxes was a variable universal combo. It had flexibility in terms of it was a big death benefit and payments. I could participate in the markets without going below a certain threshold, meaning obviously if I just invested in the S&P 500 index in here, I could only participate in a portion of the upside, but I was capped to the downside for my money, and it wasn't ridiculously cheap, but it was in the ballpark. I thought about it. This would have been the one, but I couldn't get myself to do it. I have term, I invest the difference, and I have other vehicles set aside for estate taxes. So I'm against it. I certainly have a whole lot of life insurance. I have term, and I ladder term up until the point where it won't be needed. So these are different insurances. Obviously, we can tell which one I don't like. We can tell this one is sort of, I don't see this one a lot. I see this one and this one not enough, because this is the one that pays the big, this is the one when you see the mutual companies advertise on TV and they sponsor basketball games and they do all kinds of stuff. This is the one that gets that dividend paid and keeps them rolling and keeps everybody, in Brooks Brothers suits is the whole life. This is my favorite. This is the right one. Life insurance is not an investment. It is a death benefit. It should be treated that way. Just because vehicles come out and Wall Street's allowed to sell them and Main Street's allowed to sell them doesn't mean we should buy them. Just think about mortgage-backed securities in 2007. So this is my favorite by far, and I'm going to now show you a comparison just recently of whole life versus term life by term invested difference. So you have a 35-year-old male, non-smoker. He's $100K a year. $500,000 whole life policy. The premiums are $6,240 a year. Of course, year one, you paid $6,240. There's zero cash value, and you've got $500K in death benefit. Year 5, you have $14K. Now, obviously, you can do the math on 5 years at six. So you're paying over $30,000. You got half that. Well, the best way I've heard this described by a really good guy who sells whole life, and I haven't talked to him in years. He says for the first 7 years, the policy has to marinate. That just sounds super cool. I got to tell you, that's awesome. I hope he's still using it, because I would even buy any policy saying that. What he really means is for the first 7 years, they roll you on all the costs of the insurance, so they're making a ton of money. The person selling you the policy gets an 80 to 100% commission of your first year premium, plus they get they don't want it to lapse for a while. I mean, they'd love it to never lapse, but really they don't want to lapse in that first 10 years. After that, they really don't care, and they're going to tell you they do. They're getting renewals. Love renewals. Two things they love: renewals and selling you big whole life policy. This is not a big whole life policy, obviously. I'm using it as an example because it's real. People who sell term life don't sweat renewals because no one's not going to renew because it's a fairly priced death benefit as to what it should be. So let's continue on before I get on my soapbox more. Year 10, 43K. Oh, by the way, this is the guaranteed. We'll get into the non-guaranteed. 20 years, year 20. $116K, guaranteed. And when you're 70, because this was set up so when he turns 70, he's going to start taking withdrawals out of the account. When he's 70, 250,000. Now, he had put 218,000 in it from 35 to 70. Okay? The death is the same. Okay? So, the non-guaranteed cash value at year 1, big surprise, is 0. Year 5, 16K. Wow, big jump. Year 10, 55K. Year 20, 180K. And when he's 70, 510K. So it's better. So the non-guaranteed is assuming that the cost of the insurance is going to be what it is today, and the dividends they're paying now is going to do it. So I'll buy all this. I'll buy all this. 70 years old, you put in 218,000, so and you basically doubled your money in 35 years. But you have a death benefit. This is the non-guaranteed death benefit of 926,000. That's good. At 70 years old. Okay? So now you're going to start taking from the 510. You can do that tax-free. Sounds okay. I'll buy that. Let's look at the difference between that and term life. Same thing. 35-year-old male, non-smoker, 100K. $500,000 death benefit. $1,080. Oh, and by the way, this is based on the average dividend that I'm seeing now of 5.19%. Now you can do paid up additions, you can do all kinds of other things, but that's the dividend's pretty good right now, so that's what you're getting. So 1,080 is the annual, as opposed to 6,240. So we're going to invest the difference in year 1. I'm sorry, we're not going to do year 1. Let's do year 5. $34,546, and this is the S&P. We're not going to try to beat the S&P, even though we'd kill it. We would beat it, especially now. How would we beat it? But let's assume we're just going to be the market. Year 10 of being the market is 95,400. So 95,400 year 10. We still have $500,000 in death benefit. Year 10, $55,000. Half the money, and we got probably around $600,000 in death benefit. Well, yeah, but this is taxable money, Rick. Yeah, okay, I understand that. I'm fully aware. And by the way, this is just insurance. We'll take the same, this 35-year-old, we're assuming can afford this. We're saying that he's got all kinds of other vehicles. Because remember when we buy whole life, we've got everything else maxed out. And then we still don't buy it. So, year 20, $391,820. And by the way, this is based on 30-year policy. That's why it's a little bit more. If there was typically it's 20-year. If this was 20-year, this would be cheaper. But I did 30-year. I could have done 35 to get you to 70. But what's the point? Because at 70, it's going to fall off. And then at age 70, you got 2,347,383. Now, granted, sure, that's because it's only a 30-year policy. So here we have a death benefit of 0. Here we have $1 million. Add the $1 million to the non-guaranteed 510,000, and we're 1.4. Here we're double that. And oh, by the way, all we did is invest is in the index, low cost. Any time around the way here, we could have re-upped re-upped another 20 or a 15-year policy. In fact, let's assume at age 50, we bought another 30-year term policy. Now that would cost more money. We could take that out of some of our earnings. We could do that, and let's say we did that. We could still have a death benefit here. But my point is, so the 218,000 put in here gets us 1.4. And oh, by the way, if we die, this gets paid, this goes. So if we die here, we don't have this, but guess what? This stays. So there's no comparison or any time or any way that this matters. And hey, you can take this out anytime you want. I understand you can take a loan from yourself, but you know, then the death penalty lowers. And if at 70 you say, I'm just going to take my 510 and roll, that whole 510 is taxable. They want to keep this alive. So this being said, there's absolutely zero comparison in terms of which one you should do. Full disclosure, to roll whole life completely, I should have done at age 50 another 30-year policy, so I get it to 80. Because after 80, unless you've got massive estate planning needs, and some people do, but for the mass affluent, term life is the way to go. Invest the difference, though. That's the key. And remember, this is all this was. This and then the difference was what you would have paid on the whole. So go get a whole life quote. Make their day. They're going to be prepared. It's going to be an hour-long presentation. It says, oh, my foot hurts. You need whole life. I'm unemployed. Whole life's going to take care of you. You know, I can't afford my mortgage. I want to buy a house. Whole life. But get the quote, and then whatever the quote is, still buy the term life, and then invest the rest of the quote, or even half. You'll still be better off. Remember, 40% of these lapse after 10 years. They're not sold properly. They're ridiculously expensive, and for no need. We'll take this over the possibility of this any day of the week. And oh, by the way, that's assuming the index, and we know the index can be beat if you do things the right way. So that's life insurance. You need it, please get it. Absolutely have it. But I'm seeing way too much whole life being sold right now. That's because the masses all still think we're going to have a massive bear market for 20 years. That I'm still hearing the L shape. As I believe we were up 600 points today. I don't know. I have more two-baggers than I can talk about in terms of, it's a stock picker's market. I am a stock picker, but even the indexes have been great since the March lows. So it's making me look somewhat intelligent in terms of what I knew was going to happen. I can tell you the cover of Barron's magazine was, small businesses will dictate the economy. Well, we own a small business. My small business, I can tell you, is a service-related business that services Fortune 100 companies, and things are starting to harden the right way. We've done well through COVID, but things are hardening in all of our different sectors in a positive way. So that's a really good indicator, and continues to dictate what I've been saying. And for those of you who don't who need to know this, the economy and the stock market are two different animals that act differently, but they're based on, essentially, they should be based on the same thing. So as the economy comes back, we're going to continue to see a strong market. We are not in a bear market upswing. We are in the beginning of, I think, of a wonderful, at least 2-year massive bull market. So if I said anything you like, please like and subscribe. If you're a life insurance agent and you don't like what I said, I don't really give a shit. That means I did my job. Because if you were a life insurance agent who understood what I'm saying, you'd know that I'm right. You could give me instances where whole life probably makes sense to you and to maybe some of your clients, but in essence, what I'm saying is what I believe is right. And that being said, I'd love the comments. I love them good, bad, or indifferent. And we'll see you next time. Thanks.